a 40-year high in inflation, rising interest rates, talk of our property market crashing, and even talk about our economy falling into recession. Then there's Russia's war with Ukraine. There's a spike in energy prices, skyrocketing jump in the price of petrol. We've got supply chain problems, excessive government spending, exploding government debt, and a huge increase in the nation's money supply. And all these factors and others are contributing to increased inflation. But am I worried? Not really, and neither should you be, and I'm going to explain that in today's podcast. Now, if you're a regular listener, you know I usually have guests on this show, but today I think this topic is too important, so I want to speak one-on-one, just me and you, about this. And if you're one of the many, many new listeners that subscribe every month, welcome, and you'll hopefully learn a bit about inflation, why I'm not worried and why you shouldn't be. And as a new subscriber, you can go back to some of the other shows and listen to the very many property, finance, money, economic experts I have. But today, let's talk about inflation. So welcome to this episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I think when we look back at 2022, the year's going to be seen as the year of inflation. Now, sure, it started in 2021 because of the massive disruption that COVID has caused in the world. But inflation's on everyone's radar now, isn't it? And it's continuously in the media too. Now, I'd like to say I've never seen so much rubbish written in the media before, but I'd be lying. I read the same kind of misinformation when we experienced the global financial crisis way back in 2008. Back then, all the commentary was about it. Economic Armageddon and crashing property markets. And it was many of the same doomsday experts who gave us dire warnings when coronavirus caused those original lockdowns back in 2020. But once again, the government and central banks, their policies helped us avoid the terrible bankruptcies that people said was going to happen, the double-digit unemployment that people forecast, and the 20% house price falls that were predicted back then. And this is often forgotten at present, as many Australians are worrying about rising interest rates and property values falling. They've forgotten how we've gotten through these challenging times before. Now, I've invested through inflationary times before, and I know how good it can be for people who own the right assets, particularly property. But currently, many people are finding it difficult to have any peace of mind during a period of high inflation like we're experiencing at the moment. You see, we haven't seen this in the developed world for decades. And it's really uncomfortable if you're facing higher prices for everything every single month, going to the petrol station, fuel costs, energy costs. And the average Australian's hearing things about the current economic problems every day. And that makes it even worse. We're hearing things like inflation's getting higher, the stock market's down, Bitcoin's crashed, property values are going to crash. Things are looking like stagflation, high inflation and low economic growth. And hey, maybe we're even going to have a recession. So it's no wonder that people are feeling uncomfortable. Now, in a moment, I'm going to explain exactly what inflation is and what I believe has caused it and what I'm going to do about it. But before I do, if you're worried by all this, my message to you is look at the big picture. You see, when we're faced with economic problems, or I guess any problem, there are two ways to view things. You can get up close, you've got this up-close perspective, you look at inflation, interest rates, debt, consumer spending, joblessness, and so forth. Or you can step back and take a broad perspective. And my recommendation is look at long-term trends and historic patterns. You can get tunnel vision during periods of high stress like this. So I always suggest just take a step back. Take a broader view. What happened in the past can teach us about what's happening now. You see, our property markets and our economy, they move in cycles. There have always been periods of high growth and periods of low growth. And, as the platitude says, history doesn't repeat itself, but it rhymes. For example, when our economy gets stimulated, like it was in 2020-21, people get more excited, they take more risks, they start to consume more. And this period of high growth often causes inflation, and then things start to slow down again. It goes up, it goes down, but we never seem to spend time in the middle. Our economy and the share markets and our property markets, they always seem to be at extremes. So recessions and slowdowns are normal. Despite the screaming headlines that you see in the media or those so-called gurus that are telling us that the sky's falling, sure, Australia avoided a recession for a long, long time, but economic slowdowns and strong times, the cycles are normal. Interestingly, our research at Metropole has shown that Australia's property markets have increased in value by over 540% over the last 42 years, and that averages at around 8% on average, and some states clearly have done better than others. So again, I'm suggesting you go back to the long term, and when you invest for the long term, the market fluctuations don't harm you. Well, especially if you own quality assets. I guess that's a proviso. You've got to own the right assets, investment-grade assets. Things only become problematic when you make bad investment decisions, such as owning secondary assets, or if you've over-borrowed, or if you don't have the cash flow to see you through the challenging times, or if you've taken unnecessary risks. So we talked about inflation. Let's get back to it. What is inflation? Well, there are many definitions, but I like this one. It says inflation is a persistent, substantial rise in the general level of prices related to an increase in the volume of money, resulting in the loss of the value of a currency. Let me say that again, because it's actually different to what most people think. Inflation is a persistent, substantial rise in the general level of prices, but the bit that most people leave out is that it's related to an increase in the volume of money, and it's therefore causing a loss of the value of the currency. You can't buy as much with your dollar as you could a year or two ago. Broadly, inflation is really just an imbalance of supply and demand, but most people forget about the underlying factor of the volume of money. You see, there are a lot of factors that affect certain prices in the short term, and there are some factors that affect the price of a large number of items in the short term also. Things such as supply chain issues caused by the war in Ukraine or the lockdown in China. The only thing that affects the price of everything all the time and over the long term is actually the volume of money, how much money is floating around the system. Now, just to make things clear, a level of inflation, an amount of inflation is actually normal. So you don't actually have to fear that inflation exists. In fact, it's healthy. It's a healthy part of the economy. The issue is when the amount of inflation is inappropriate. It could be either too much or opposite, I guess, deflation. Hyperinflation, that can be extremely harmful to consumers. If the cost of living rises considerably more than people's salaries, obviously the standard of your living goes down. On the other hand, deflation, on the other side, is undesirable also. No one likes to see the value of their assets go down, do they? So what causes inflation? Well, inflation is caused by pressures like supply and demand on the economy, as I already mentioned, money supply policies, and even consumer expectations, because that will decide how much we spend or are prepared to spend. But today's high rate of inflation was caused, well, in part by factors relating to the coronavirus pandemic. During the difficult years of 2020-2021, when large parts of Australia were locked down, the government crafted a number of stimulus measures to prevent us falling into recession and to prevent those high levels of unemployment that were predicted. Remember, people thought unemployment would get to double digits, 11, 12, 15% unemployment. And the government gave us stimulus with low interest rates and stimulation of the building industry to prevent the real estate Armageddon that some predicted. And this was in part done by entering into a program of quantitative easing, which basically reduced interest rates, increased the supply of money, and drove more lending to consumers and businesses. And it worked. We didn't have all those terrible things that those negative Nellies predicted. But during those times when we were sheltering in our COVID cocoons, most Australians stashed their cash. We built up a war chest. We paid down our credit cards. We paid down our mortgages. We put money into our offset accounts. Look, on the one hand, we weren't able to go out and spend our cash, and on the other hand, many Australians were cautious. We were uncertain about what was ahead. But now life's back to normal again, and Aussies are getting out again and spending more, and this is occurring at a time of limited supply for many goods. A limited supply of many goods pushing up prices and therefore causing inflation. Now, until the novelty wears off, or until price rises get to the level where they really impact demand or consumption, we're going to continue to see pretty high levels of inflation. So in essence, inflation was caused by the government, and now they're asking the Reserve Bank, hey, why can't you get inflation under control? Rather than admitting, well, it was the previous government that caused significant stimulation by the printing of money. So it's likely we're going to have significantly higher inflation for quite some time because of the continuing problems in Russia and the Ukraine war, because of supply chain issues related to the Chinese lockdowns because of coronavirus. In fact, the Reserve Bank's now expecting headline inflation to reach 7%, and it's not expected to peak until the fourth quarter of this year, 2022. And that's in part because there are still things flowing through into the system, higher energy prices, higher power prices. That won't flow through to households for a while yet. So it's likely that after the end of this year, the annual rate of inflation is going to start to decline. And the Reserve Bank is going to try and control inflation by raising interest rates and stifling demand. Now, one thing that lowers inflation is inflation itself, because, in fact, people just aren't going to spend as much. But the problem is, if the Reserve Bank raises interest rates too fast or too high, it'll suppress demand too much, and we could fall into a period of recession. In other words, 2 quarters of negative economic growth. But if this occurs, the recession is likely to be short-lived, as the Reserve Bank is going to then lower interest rates to grease the wheels of the economy again and get things going. Unfortunately, we are entering this challenging period with Australia's economy in really good condition. It's growing well. It's going to slow down a bit, but not like some other countries. And we've got strong jobs growth, low unemployment, strong exports, and a positive balance of trade. And just like we got through after the global financial crisis with a mining boom, it's unfortunate this situation that's happening overseas, but Australia is in a great position because the things we grow and the things we dig out of the ground are in strong demand overseas. So it's very likely that our economy is going to do well because we're going to be able to export minerals, fuel, and food. So that's going to again save our economy like it did before. Well, having said that then, how worried should property investors be about inflation and rising interest rates? Well, let's be blunt, we've now entered the next phase of the property cycle, one where the market's cooling. And yes, prices are adjusting. And while property values will correct in some locations, there won't be a property crash as some commentators are predicting. Yes, the higher end of the market is already slowing down a bit. It always does because it exhibited very, very strong capital growth. But for house prices to crash, that's what people are suggesting. In other words, you're reading and hearing that the Australian property market is going to drop 15-20%. We know there isn't an Australian property market. There's a Sydney, Melbourne, Brisbane market, and within those capital cities and all the other capital cities, there's apartments and townhouses and houses. There's the inner city, there's the outer city, there's regional markets. There's never been a time, never, when the property market overall, the Australian property market has crashed 15 to 20%. Certain segments have, no question about that, for short periods of time. But it's unlikely to happen at the moment. Because for house prices to crash, we need to have forced sellers, nobody there to buy their properties. In other words, property values free fall. Now, this is more likely to happen at a time when there's high unemployment, when people just can't keep up their mortgages. And we know banks don't want to foreclose. We know banks don't want to take over your mortgages. We've seen that recently through the COVID pandemic. And currently, anyone who wants a job can get a job. And with rising wages, it's unlikely we're going to have many distressed sellers, many sellers forced to sell that will cause property values to crash. Sure, some recent buyers are going to find high mortgage costs a financial challenge. But there's likely to be little overall mortgage stress. You see, those who recently purchased would have gone through really strict lending criteria, those hurdles the banks put to them to make sure they could cope with rising interest rates of 2 and even 3%. And for those who've got a mortgage, even when interest rates rise a couple of percent, and they most likely will rise a couple of percent, interest rates are only going to be at the level they were prior to COVID, when the same homeowners and investors cope with their mortgage. And if you think about it, 50% of homeowners have no mortgage on their homes at all. They're not going to be worried about rising interest rates. And most other homeowners, those who bought their home a couple of years ago or more, they're going to have substantial equity in their properties. And we know that most of them are months ahead in their mortgage payments and they've got cash stashed in their offset accounts. We also know that a very large percentage of mortgage holders are on fixed rate mortgages. Now, they're going to revert to variable mortgages next year, but in the meantime, they can get ready, they can get prepared, they can stash their cash because their mortgage payments are not going to go up either. However, some who recently purchased a property and haven't experienced market cycles, they will find the current market conditions concerning. But they should take comfort in the fact that property corrections tend to be short-lived, and the Reserve Bank doesn't want a housing crash. It wants it about as much as it wants another strain of coronavirus. So these property owners should remember that the decline in property values will be temporary, while the long-term increase in property values, that's permanent. So I'm sure that property values are going to continue to rise substantially over the long term, and they're going to be underpinned by our rising population at a time of significant undersupply of properties. And at the same time, in general, we're wealthier than we've ever been. So our increasing wealth is going to mean we're going to be able to pay more for properties. And of course, the situation is only going to be exacerbated by the opening of the floodgates for hundreds of thousands of migrants. And they don't bring homes with them when they come to Australia, do they? So, yes, I know people are nervous at the moment, but we also know that fear and greed drive our markets. During the recent boom times, greed, FOMO, fear of missing out, drove property prices up strongly. And today, phobia, fear of buying early in a falling market and looking silly, is holding some buyers back. What they don't realise is that the property price declines mean that they're getting better value for the property they're buying. And those who are worried should realise that the regular market declines, well, it's just a fee for admission rather than the fine for getting it wrong. It's the cost of being in the market. It's the cost of long-term success in property. So rather than worrying about, getting the timing right, they should buy when the time is right for them. If you've got a secure job, and you've got the money, now's the time to buy a property with less competition. The current adjustment phase of the cycle gives investors an opportunity to get great properties without the same level of competition you would have encountered a year or two ago. This is going to allow you to do your due diligence and to focus on buying the best asset you can afford and owning the right properties, investment-grade properties, ones that will deliver the type of strong long-term growth that will help their owners enjoy lifetime wealth. That's the sort of asset you need to own. That's the sort of property that's unlikely to drop much in value moving forward. But sure, investors aren't going to experience the same level of capital growth in the short term they did last year, or they will in a year or two's time. However, as a property investor, you're going to benefit from strong rental growth over the next couple of years. Vacancy rates for both houses and apartments are at historic lows, causing rents to surge. And there's no end in sight for that. Of course, it's all got to do with supply and demand, and at present, the competition for rental accommodation is so high, and tenants have got very, very little choice. The number of rental properties around Australia is trending lower month on month. At Metropole, we manage over $2 billion worth of properties for our clients, and we can see how our vacancy rates are low and rents are going up substantially. So it's a great time to be a property investor. It's just that time of the cycle. So why is the rent supply so limited? It's probably worth just having a quick chat about that, because it's not just what's happening now. It started back in 2016-17 when APRA restricted funding to investors. At that time, there were probably a few too many investors there. I remember in Sydney, close to 50% of all transactions were to property investors, many of them foreign investors. And APRA tightened the screws on investors, meaning the number of investors providing rental accommodation decreased. Interestingly, during the pandemic era of the last couple of years, many investors sold up. They shouldn't have. Their properties were doing what they were meant to do. They were going up in value. But in general, they sold up to owner-occupiers, placing even more stress on the housing market with less rental stock. And now a lot of properties that for a short term were on the general rental market have gone back to Airbnb. Interestingly, at the same time, the average household size has got smaller. Many young renters fled shared houses for the safety of 1 or 2 bedroom apartments. And of course, more recently, with our borders reopening and tourism increasing, as I said, many of the properties that were put on the long-term rental pool are now back on Airbnb, lowering the number of properties for long-term tenants. It doesn't seem like rental demand is going to ease anytime soon. As I said, particularly with our borders reopening and international students returning, they're going to fill the once vacant CBD apartments as well. And most migrants rent initially for a few years until they get their bearings in their new homeland. So back to inflation. What should you do about it? Well, it's likely the media is going to keep feeding us headlines of fear for much of this year. So there are some things you can do. First of all, focus on educating yourself and on mindfulness. You see, the economy is affected by various factors, most of which are out of your control. So rather than letting that worry you, as I said before, take a long-term view and focus on things you can control. Whether it's property, shares, Bitcoin, booms don't last forever, but neither do downturns. So think long-term and don't look for quick wins. And don't let emotions drive your investment decisions. Just remember back to early 2020. It wasn't that long ago, during the peak of the scare of the COVID epidemic, when fear started to rear its head then. Look how wrong all the predictions were then. The thing is, downturns are just one part of the cycle, so they're always going to end at some point. The other suggestion I've got for you is stick to your strategy. Don't change your long-term investment strategy because of short-term factors. Look for what's always worked rather than what's working now. Your long-term wealth is going to be created by the capital growth of your property portfolio, increasing your asset base. Now, don't change your strategic plan. Oh, by the way, you do have a strategic property plan, don't you? Now, if not, maybe now's a great time to speak with the property strategists at Metropole, because before we even talk about property or where or what, we build a strategic plan for all our clients. Now, we're using the same formulas, strategies, fundamentals, frameworks that I've fine-tuned for over, almost 5 decades and invested through periods of high growth, low growth, high interest rates, low interest rates, high inflation, no inflation. And my team have been delivering this to clients for over 20 years. Interestingly, a recent audit of our clients showed that our clients are 7.3 times more likely to own 6 or more properties than the average property investor. In other words, they're 7.3 times more likely to be in the top 1% of property investors. So why not go to metropole.com.au and find out about what we do, because we provide a range of services, including strategic property advice, buyer's agency, property management, renovations, development, wealth advisory, financial planning, business advisory. And you can trust us because we've got no properties for sale. So we're going to give you direction, guidance and results. Whether you're a beginner or an experienced investor, it's time like this that you really need an experienced advisor, somebody who takes a holistic approach on your side to help in your wealth creation. And that's exactly what you're going to get from my team at Metropole. So go to metropole.com.au, find out about what we do, and leave us your details. Now, I guess to leave you with a final message, the bottom line, strategic investors don't really care too much about the stage of the cycle. Instead, they concentrate on growing their portfolio and investing in the right type of property when it suits their finances, when it fits in with their strategy and their long-term goals. Remember Warren Buffett's words, be fearful when others are greedy and greedy when others are fearful. Now, sure, it's difficult to take action when others around you are talking doom and gloom. But it's times like this, during downturns, during the adjustment phase of the property cycle, that lifetime wealth is made. And I've seen that. I've seen that having invested for close to 5 decades now and helped thousands of investors. So we are in for an interesting year, as I started to say, a year where there's going to be inflation and scary headlines for quite some time. But I hope my chat with you today has given you some better understanding and some comfort.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
The mindset message I'd like to share with you today is that the moment is not permanent. Now, what do I mean by that? Well, why do babies love playing peekaboo? Well, apart from the obvious fun, especially for adults, and I know that as a grandfather, it's because up till about the age of 5 months, babies haven't yet developed what they call object permanence. Object permanence is our knowledge that objects continue to exist even when they can't be seen, heard, touched, smelled or sensed. That's what psychologists tell us. Now, while this is a vital survival mechanism, it also means that as adults we've got a tendency to think that it'll take us longer than expected to recover from an unpleasant event. These events have got power over us because we continue to relive them in our memories, trying to make sense of the trauma, trying to make sense of the confusion. It's this tendency to think that things are permanent that causes us to get stuck. Today blends into tomorrow, and whether you felt that your day was good or bad, it's unimportant because your thoughts are limited by the possibilities that arise from that one thing, the thing that went wrong. But things can change in an instant. What's happening now won't go on forever. A chapter in your life is not the whole story. When you let go of the anxiety about your future and the depression about your past, you'll feel the only thing that's available to you is the present moment, and what you make of it. So don't treat a bad day like it's been a bad year, because this date, the date you're listening to this message, will never come again. Each breath you take is a precious gift that somebody else is fighting for. There are people on this planet who would love to be in your position, in your location, have the life that you've got. So rather than remember those bad memories, think about what you're grateful for right now, because you'll never become wealthy unless you have an attitude of gratitude. Well, thank you for spending the last half an hour with me, and I hope I've given you a bit of clarity about inflation and what's ahead. But I'm going to be back twice a week to help you get through the challenging, more scary times. And as you know, normally I have experts with me as well to talk about what's happening with the world and the economy. But if you got some benefit from today and you know somebody else who'd get benefit, who would benefit from understanding a bit about inflation and what to worry about and what not, why not tell them about the Michael Yardney podcast? There's a share button on every podcast app, or you can just tell them about it in the old-fashioned way. Of course, it'd be fantastic if you left me a review as well, wherever you listen to this podcast. Now, I'll be back again real soon, but you can catch me in between on social media. Just look for Michael Yardney, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. Every day I leave some tips, some information, some charts, things I don't leave elsewhere. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?